So in just 1 year, I 2x my stock portfolio, have more than $10,000 in unrealized gains, a 32% portfolio return, and even after taking profits on my positions, I'm still up big on many of my holdings like Tesla, Etsy, Microsoft, and Costco. At least that's what I would say if I wanted you to buy my online course bundles costing several thousands of dollars. But just like I don't have neon green hair, I don't have any courses to sell you, so let me drop the financial guru facade because I started this channel to show you my investing journey, all the good and the bad, the highs and lows, and while I do have these stocks in the green, I also have my share of reds. So let's talk about my losers, what companies they are, and my reasons for holding and continuing to dollar cost average into them. Starting at the bottom, and a quick portfolio update, are my 3 newest positions consisting of VOX, VGT, and VCR. These are Vanguard's index fund ETFs that are sector specific. I'm going to slowly build out these positions because they offer growth while minimizing risk with their diversification. VOX is communication services with these 10 as their top holdings. VGT is Vanguard's information technology that holds these 10. And VCR is Vanguard's consumer discretionary ETF with these as its top positions. And sure, I might get better gains if I go all in on Tesla. By owning these sector-specific ETFs, I can still pick and choose what industries I'm more bullish on, while still getting the safety of buying a basket of stocks. But going back, since I'm dollar cost averaging in, the gains and losses are pretty neutral right now. So let's get into the fun stuff, my individual stock positions, and currently down 2.96%, we have MasterCard. And most of the stocks you see in today's videos are ones I bought and held since my first buy on M1 Finance back in 2018. So even though my starting cost basis in MasterCard was $211.92, consistently dollar cost averaging into it over the years brought that up to $366.87. And this is the case with most of my stock holdings. Dollar cost averaging means you buy when it's low, but also when it's high. So right now my MasterCard average is above the current share price. But regardless, the reason why I will continue to buy and hold MasterCard and also Visa is because they're still the leaders in payment processing, and with the world bouncing back from the lows of last year, they're not going anywhere. The Delta variant fear did hamper their bounce back, but with borders reopening up and people starting to travel and spend more money, MasterCard is already seeing a massive recovery. According to its latest earnings report, their gross dollar volume is up 33%, and cross-border volume is up 58% compared to 2020. And even looking at just 2021, we see MasterCard's gross dollar volume up 19%, while cross-border volume is up a healthy 11%. So in a way, MasterCard is my indirect recovery play, but I do have a more direct recovery stock in my next red position, Uber, currently down 3.07%. But that really isn't my true return because in my top 10 best performing stock video released this January, you can see my Uber's average share price is $28.87. The only reason why it's now $49.89 is because of my April Fool's Day video where I sold all my individual stock positions to buy VOO, just like that Warren Buffett advice that I tell people to ignore. I did buy back all my individual stocks I sold, and yes, you're correct in thinking that was a stupid idea because it messed up my actual unrealized gains. But that video did give me 471 views, so no regrets. But once again, even though my average share price for Uber is higher and I'm currently in the red, I plan on holding Uber for the long term. Because not only did their business rebound 114% year over year, they anticipate a stronger third quarter numbers, recently upping their gross bookings, and they might even post its very first adjusted profit compared to their previous anticipated loss of around $100 million. So while it's still definitely riskier than MasterCard, Uber is my somewhat tame spec play where there's still huge upside when they finally decide to go for profits. And next up, we have Disney down 3.11%, and it has been on a downward slope since March, and a recent pullback happened when Disney CEO said that they anticipate their streaming service to have less growth. And it's always baffling how short-sighted investors are, because keep in mind, Netflix currently has 209 million subscribers, and Disney Plus launched less than 2 years ago, and already has 116 million subscribers, with 12.4 million subscribers added in its most recent quarter. I mean, even if the CEO is right, and let's say worst case, Disney Plus only added an additional million subscribers for their upcoming quarter, that's still 117 million subscribers, or an average of 14.6 million subscribers added every quarter since it launched. In comparison, Netflix just released their third quarter report and they added only 4.4 million subscribers last quarter. I mean, Disney isn't going anywhere. Their movie and theme park and cruise business will bounce back and continue its dominance in entertainment, so definitely a long-term buy and hold. I'm going to keep buying into the position. 3 more to go, and the next one is a plant-based food company that Jeremy from Financial Education wouldn't stop talking about back in the day, and is Beyond Meat, currently down 7.98%. It's been a rough year as a whole, as you can see from their 1-year chart. Kind of similar trend line to Tattoo Chef, but Beyond Meat is a relatively new position of mine that I started on March 15th of this year, buying in at $146.72. Now, if that was my only buy-in, I would currently be down 35.32% right now. But like I always do, I dollar cost average as the stock crashed, and currently I have a less depressing average share price of $114.81. And yes, even though it's now trading at a new 52-week low, I'm willing to hold this for the long term because their new manufacturing facility in China just opened this April, and their latest product, Beyond Pork, which is created specifically for the Chinese market, it launched in September. So definitely a long-term buy and hold to see where it progresses. And runner-up to my worst performing stock, we have Boeing, currently down 10.77%. And let's for a moment forget about this Starliner space capsule delayed until next year, and some of its workers protesting the vaccine mandate. Where do you see Boeing is going to be in the next 5 or 10 years? Because I see people getting over the fear of flying the 737 MAX, just like people did after 9/11, and even now, orders are trickling back in for the 737 MAX, and don't forget, Boeing don't just make commercial planes, and they're dominant in the air freighter market with their wide-body cargo jets. And most people forget that Boeing is also a massive defense contract with products like the Apache attack helicopter, Air Force One, and the B-52 Stratofortress. And here are just a few of the defense contracts Boeing was awarded as of June of 2021. And sure, people like to throw around too big to fail for many companies, but Boeing is by definition too big to fail with a number of direct and indirect jobs and companies it supports. Plus, hell is going to literally freeze over before the United States government lets it go under, because Boeing is a duopoly with Airbus, and the United States isn't going to let Airbus steal their thunder. Another tailwind for Boeing, their test flight to get cleared to operate in China went off without a hitch, and hopefully leading a way for them to start flying again in the world's largest aircraft market. But speaking of China, let's reveal my biggest loser, and you already know if you watched my last video, but we have good old Alibaba down 22.27%. Now, starting with Jack Ma's poor word choices that led the Chinese government to shelve Ant Group's IPO and the subsequent crackdown on Chinese tech companies, Alibaba's share price hasn't been this low since back in late 2017. But the main thing you have to think about before investing in Alibaba is whether you believe Alibaba is the same company today as it was back in 2017. And it clearly isn't. Because here is Alibaba's financial statement, and revenue is up 400% and net income is up almost 200% in the last 4 years. And regardless of where Alibaba is trading at right now, fundamentally it's stronger than ever and continuing to increase its market share and innovate new technologies. For example, they recently launched a new server chips to better compete with Amazon and Microsoft in the cloud computing business. And all this fear of Jack Ma disappearing and the CCP taking over Alibaba is way overblown. Here's Jack Ma chillaxing in Spain. And while anything is possible, the Chinese government, they're not going to take Alibaba private because that is going to destroy the financial future of other Chinese stocks trading internationally and lead investors running away from ever investing in China. No. China just wanted to show Alibaba who's boss and to keep it in line. And they did just that by disappearing Jack Ma for a while and asking Alibaba to donate to their cause. But if you don't believe me, a random YouTuber, maybe you'll trust Charlie Munger, Warren Buffett's business partner, who increased his Alibaba position 53% in the third quarter. But as always, make sure you do your own research and don't blindly follow someone with $45,627.51 or a couple $1 billion. So there you have it, my current red losers and why I'm still invested in them, and give it time, these will of course be replaced by other losing positions. But regardless, I'm investing for the long term. We're going to just wait and see where they land in a few years. But in the meantime, like and subscribe to get front row seats into my investing journey, and get your free $30 when you use my M1 Finance referral link below. But with all that said, happy investing, stay safe out there, and I'll catch y'all next time with more financial shenanigans.